Welcome to Alu Speaks with Alu Patience. Today we'll be discussing on the topic the principal financial statement in the course Corporate Finance. This is our first topic on Modus 2. If you have not watched our previous topic, I would advise you to do so. However, do not worry. I have realized that most of us do not have a business-oriented background. So I'll be breaking down this course to be as simple as ABC. At the end of today's topic, we should be able to understand the meaning of generally accepted accounting principle, understand how generally accepted accounting principle affects the preparation of the financial statement, understand what a financial statement is and the major parts of a financial statement. We will go ahead and discuss the importance of the financial statement and the importance of generally accepted accounting principles. If you are still here, please like, subscribe and follow. And do not forget to click on the notification button so that you do not miss out on future amazing topics. Before we go into discussing how to prepare the financial statement itself, let us first understand the principles guiding the preparation of a financial statement. These rules, these principles are embedded in the generally accepted accounting principle, that is the GAAP. As the name implies, the generally accepted accounting principles are principles that are generally accepted by persons or people who prepare financial statements and book of accounts. These principles dey govern how financial statements are constructed. What I mean here is that there are a set of standards that must be followed in the preparation of financial statements. These accounting principles, they were developed by the Financial Accounting Standard Board. So how does this set of principles influence the preparation of the financial statements? What I'm trying to say here is that what is the importance of this set of rules? What is the importance of these generally accepted accounting principles? Let us explain them. They ensure uniformity in the preparation of financial statements across industries. That is, they ensure that all industries prepare financial statements following the same method. They ensure uniformity. And where there is uniformity, there is what? Transparency. Because everybody is preparing in the same way, so there is transparency among industries in the way they prepare their financial statement. And this uniformity will also help to prevent fraudulent reporting, because it is easily understood across board. So it helps to avoid or reduce fraudulent reporting. And if we are all using uniform method of preparing financial statements, which means we are using this method over and over again. That is, we are using it consistently. Using it consistently leads to what? Leads to makes comparison easy, because we keep using the same method over and over again. Therefore, we can easily compare one year with another year. You can easily compare this year with the previous year, because we use the same method of financial reporting. And the essence of all this is to help the users of financial statements to make informed decisions, to take decisions. When they read the financial statement, they are able to take decisions on what to do or what they intend to do. What are these principles we are discussing about? Let's understand that some of these principles, some of them are concepts, some of them are conventions. But let's not get dragged down that road. Let's just list them. We have the consistency concept, the going concern concept, the periodicity concept, the cash basis, the revenue recognition principle, the accrual principles. This is to mention but a few. I just want to hit on these few ones because we will talk about them in a subsequent discussion. The consistency concept. This simply means to be consistent. That is to continue to do the same thing in the same way year in and year out. That is using the same approach of reporting from one period to the next and to the next. Why? So that we can easily compare periods. When there is consistency, it is easy for us to compare the financial statement of previous year with the financial statement of the current year. The going concern concept. This concept assumes that a company will continue to operate into the foreseeable future. We hope that a business will continue in perpetuity. That is, we assume that a company will continue to operate year in and year out. That is why we have the confidence to buy things like assets, like your motor van for the business, because we expect that motor van, we expect to continue to use that motor van maybe for the next 10 years in our business. What are we saying here is that we are so foreseeing our business as getting up to 10 years and beyond. Another concept is the periodicity concept. This periodicity concept, we can also call it the accounting period concept. Here, we are simply saying that your record should follow a definite period. What we are saying here is that you should distribute your record of recording accounting into an appropriate period of time. That is, accounting should be prepared at the end of every period. That is, we should group time into periods. An account should be prepared at the end of each period, not at the end of the life of the business. Usually, this period is usually one calendar year, and we do this year in and year out. The cash basis. This basis states that you should record all transactions immediately you receive the cash or you pay for that transaction. What is simply saying is that we are looking at the movement of cash in and out of the business. You are looking at the inflow and outflow of cash. That once you receive cash, record it down. Or once you pay with cash, record it down. This is one of the most common type of accounting methods people use, most small business use. Once they receive cash, they record. Once they pay out cash, they record, because this is a simple method. But the problem with this method is that you cannot actually calculate you cannot get your actual profit for a particular period if you use the cash basis, because some of the money you may receive this period may be for something you sold last year. So, and when you record it this period, you may not get the actual profit for this period, because you have recorded for this period some revenue you got from last year. And we have the revenue recognition principle, or we can also call it the realization concept. This concept says that revenue should be recognized when it is earned and not necessarily when cash is received. Let me explain with a scenario. When you sell goods on credit, you will recognize it that you have made a sales, that you have earned a revenue, even if you have not even received cash from such sales. Is that not so? That is what it's simply saying. That you should recognize it because you have earned it, even if you have not received the cash yet. It also says that expenses should be recognized when they are incurred, not necessarily when the cash is paid. For instance, if you buy goods on credit this month, you will recognize that you have made a purchase. Even if you have not paid yet, you recognize it. That is what the revenue recognition principle is saying. It's simply saying that revenue should be recognized when it is earned and not necessarily when cash is received, and that expenses should be recognized when it is incurred and not necessarily when cash is paid. The accrual principle. The accrual principle is just one step higher than the revenue recognition principle. The accrual principle is saying that all revenues should be recorded when they are earned, and all expenses should be recorded when they are incurred. It does not matter whether cash has been paid or cash has been received. I know when we hear the word financial statement, we are jittery, like how this is going to be difficult. This is all about accounting. But calm down. We are not here to learn how to prepare the financial statement. We are simply here to understand how to read, how to understand, and how to interpret the financial statement as managers. As future potential managers, if you do not know how to interpret a financial statement, you may not be able to contribute effectively as a manager. That is why understanding how to interpret information in the financial statement is a real life skill you must learn, not just for exam purpose only. So what are financial statements? Financial statements, they are simply reports that summarize all the activities and financial performance of a business for a particular period, usually 12 months. These financial statements, they are used to provide information about the reporting entity's assets, its liabilities, its equity, its income, and its expense. I will explain all these big terminologies I am putting down. And the reason why financial statements are prepared is to show people how management are running the company. It is to help users of financial statement to make informed decision and to be able to assess the future prospect of cash flow in that company. That is to know how cash is coming in and going out of the company. So who are the users of the financial statement? They include the managers, the shareholders, the lenders, the suppliers, the government, and the employees. The managers, they need the financial statement so that they can make informed decisions on how they can run the company effectively and efficiently. The shareholders, they need this information to help them assess the manager's performance and to be able to determine the profitability and stability and growth of that company, because they are the owners. They need to know this information. And the lenders, they need to know this, they need the financial statement to know the financial health position of the company, to know if the company can pay its loan and interest as at when due. Even the suppliers and the creditors, they need to know if the company can repay, has its repayment capacity, if the company can repay back their credit as at when due. The government also need this information so that they can assess the tax. It's the tax payable to the government. That is how much they will charge the company as tax. And even the employees need this information to enable them assess their job security and even decisions they have to make in their day-to-day activities in the company. Now let's go into the financial statement proper. The financial statement is divided into three major parts: the income statement, the balance sheet, and the cash flow statement. The balance sheet. The balance sheet is a picture of the business assets and equity. It is more like a snapshot because it shows us the assets, liability, and equity at a particular point in time. It is a statement of the company's financial position. It is a statement of the company's assets, liabilities, and owner's equity. What I'm saying here is that there are three items inside the balance sheet. We have the assets, we have the liability, and we have the equity. So what are assets? Assets are things of value that the company owns. These are things owned by and controlled by the company. They can be used by the business or they can be converted into cash for the business. I am trying to make this definition as simple as possible. Assets, they tell us what the company did with money. These are what the company did with the money that they received. Those are your assets. Liabilities, on the other hand, these are things of value that the company owes. It tells us where the money is coming from. I said that assets are the things of value that the company owns, that they have, while liabilities are things of value that the company owns. Gbese. I hope you get it. Gbese is a Yoruba word for owns, things the company owns. And we already know what equity is. Equity is the money the business owns to the shareholders. That is, this is the money contributed as capital by the shareholders into the what? Into the business. Why is this financial statement? Why is this financial statement called a balance sheet? It is called a balance sheet because the asset must always equal the liability and equity. That is, what you own must always be equal to what you owe. It explains the accounting equation: asset is equal to liability plus equity. When drawing up a financial statement, you always start with the name of the company, followed by the type of financial statement you are drawing up. In this case, we are drawing up a balance sheet. And then the period when we are drawing up this financial statement. Remember, this is taking us back to the periodicity concept. If you notice, a balance sheet time period is usually worded as at so and so, as at 31st December, as at 20th November. It's always as at, because it is a picture on a particular date. The assets in the balance sheet is broken down into current assets and fixed assets. The fixed asset is also called non-current assets. Current asset, as the name implies, current. These are assets that can be used and consumed within 1 year. Example is like your cash, your inventory, that is the stocks you have in your shop, in your factory, your account receivables, and so on. While fixed assets are those assets that a company is supposed to continue to enjoy their benefit over what? 1 year. Example is like your buildings, your land, your plant and machinery, your motor vehicle, and so on. Apart from your fixed and current assets, we also have some intangible assets too, like your goodwill and your trade name. Goodwill is an asset, but it's not a physical asset, but we can attach a value to it. Goodwill simply means putting a price tag on the reputation or customer loyalty of the business. Trade name is we can also put a tag, a value tag to trade name, like the brand Coca-Cola. It is well known, so it has a value. So what we are trying to say is that intangible assets are those assets that do not have physical forms, but they hold economic value, and they also appear in the balance sheet as part of our assets. Now, let's move on to the liabilities. Like we said, the liabilities, these are debts and payments that the company owes. Like I said in Yoruba the other time, these are the gbese that the company owes. They can also be categorized into two, into the current liability and then the long-term liabilities. The current liabilities are those liabilities or are those bills that we are expected to pay off within a year. Example are the short-term debts, the account payables, that's to suppliers, and the interest payable. While the long-term liabilities, these are liabilities that are expected to be paid off in more than 1 year. Example is our long-term debts, pension obligations to employees, bonds payable, etc. These liabilities, both the current liabilities and the long-term liabilities, these are what? These are money we owe to what? To third parties. And that takes us to the last one, which is equity. Equity, this is the money the company owes to the owners of the business. That is the money the company owes to the shareholders. This equity, it represents the company's net worth on paper. We have two sources of equity. We can get equity from the capital contributed by the shareholders, or we can get equity from retained earnings. That is profit generated, but the company did not pay it out. They reinvested it. That's why it's called retained earnings. I would advise you to get samples of a balance sheet so as to familiarize yourself on what a balance sheet looks like for practical purpose, so that you can understand it in the outside world, and also when we get to financial statement analysis, you can understand where we are driving at. Now, the income statement. This is a statement of the profit and loss of the business. This is a financial statement that summarizes the business revenue and expenses over a period of time. It helps us to know the financial performance of the business and whether that business is making profit or not. It answers the profitability question. Like I said, it is a summary of the revenue and expense of a business over a period of time. This means that it has a start date and an end date. Like we are looking at the revenue and expense from maybe January to December. This is unlike the balance sheet that will just be looking at the financial position at a particular time. That is why in the income statement, it will read for the year ended, which means it covers a span of time. The income statement is simply saying revenue minus expense is equal to profit or loss. So what is this revenue? Revenue, this is the total amount generated from the sales of goods or from the provision of service related to the companies. That is, this revenue can be from the operating activities of the company. It can also be revenue the company got from other sources, maybe like interest on loans and rent and other investments they dabbled into. While expenses, this is a cost incurred by the business in order to generate revenue. This cost could be directly related to the main product they produce, like that is called the direct expenses. It could be a cost related to the day-to-day running of the business, related to the day-to-day operations of the business. It could be costs relating to other sources of revenue, like it could be taxes paid to government. It could even be interest paid on loans. In the income statement, there are different ways to categorize expenses. It can be categorized into cost of goods sold, that is direct costs, that is easily traceable, the core goods and services the organization or company is involved in. It can be grouped into selling and distribution expenses. It can be grouped into marketing and advertising expenses, and even depreciation and amortization. Now you will ask, oops, what is depreciation and amortization? Depreciation, these are costs that are allocated to tangible assets like your motor van and your machinery. Because when you buy a motor van, over time, as you use this motor van, its value comes down. So what we do here is that we allocate an intangible cost to that motor van to show that it is depreciating over time. That intangible cost we allocate to that motor van is called depreciation charge. This is the same thing with amortization. But in the case of amortization, we are not allocating it to a tangible asset like plant and machineries and buildings. We are attaching it to an intangible asset like your goodwill, showing how goodwill appreciates or depreciates over time. Please note that the income statement, it records transactions using the accrual basis. You remember we discussed the accrual basis earlier. So why does it prepare its book using the accrual basis? So as to provide an accurate picture of the company's financial performance. It tries to match revenue earned and expenses incurred during that period in question, so that we can get the true profitability of the company. Finally, the cash flow statement. Unlike the income statement, the cash flow statement is created using the cash basis of accounting. You know, we discussed the cash basis of accounting earlier. The cash flow statement, it shows cash inflow and cash outflow in and out of the business over a period of time. That is, it looks at the movement of cash in and out of a business. The cash flow statement, it helps to track cash movements and the liquidity of a business, so that we would know if that business can meet up with its short-term obligations. We shall explain more about short-term obligations when we get into financial statement analysis. What differentiates the income statement from the cash flow statement is that the income statement uses accrual basis of accounting, while the cash flow statement use the cash basis of accounting. And the purpose of both of them is different. The cash flow statement is to check the liquidity of the business, while the income statement is to check the profitability of the business. And also, the income statement includes non-cash items like depreciation, which is not why the cash flow statement only shows actual cash movements. The cash flow statement is divided into three sections. It shows, that is, cash flow from operating activities, cash flow from investing activities, and flow from financing activities. Cash flow from operating activities. These are cash from the core business operation, like the sales of its product and the provision of its service and its related expenses. That is, this shows the revenue and expenses that is generated from the core activity of that business. Cash flow from investing activities. This is cash flow from buying and selling assets like land and motor van and investments and its related expenses. Finally, cash flow from financing activities. These are cash flows that are related to the funding of the business. They are cash inflows from borrowing, from loan repayment, from issuing of shares and its related expenses like interest on loan, dividend paid on shares. They relate to funding of the business through debt and equity. So when we add up cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity, we will be able to see if there is an increase or decrease in cash in that business for that period. And we can easily reconcile this increase or decrease we got in the cash flow statement with the difference in the opening and closing balance that we got from the balance sheet. This means that it is very easy for us to link the cash flow statement to the balance sheet. However, all the books in the financial statement are all linked together. The income statement, the balance sheet, the cash flow statement, they are all linked together. Please, like I said, do not forget to look for samples of financial statements to familiarize yourself with it, because you do not only need to know this for exam purpose, but also as potential managers you need to be able to understand, you need to be able to interpret financial statements. It is a necessary tool you must acquire.